Namaste, this is CA.Lakshman Jijnasu. In this video, we'll discuss about India's 32 that talks about the financial instruments. So we'll discuss first about the objective. The purpose of this standard is to establish principles for presentation of financial instruments, whether it is financial liability, equity instrument, or financial assets. So India's 32 focus on the classifications from the issuer's perspective, and it classifies the financial instruments in three categories. One is the financial assets, second is financial liabilities, and third, equity instruments. Apart from it, the income and expenses related to these financial instruments are also classified according to India's 32, and the classification parameters governs the nature by the nature of the instrument. So if the it is financial liability, so interest will be debited to P&L, and if it is financial instrument is equity instrument, that in that case it will be considered as a distribution of equity. Apart from the classification and income and expense classifications of financial instruments, in this 32 also talks about the offsetting rules for financial assets and financial liabilities, when the financial assets and liabilities can be offset in the balance sheet. AS32 does not work in the isolation, so there are two other standards also, 109 and 107. In combination of it, it complete phenomena works. So the presentation and classification is governed by India's 32. Recognition and measurement is dealt by India's 109, and disclosures of financial instruments is taken care by India's 107. Everything is covered except where another Ind AS dominates the area. For example, subsidiaries, JV, and associate accounting is done by Ind AS 110, 27, or 28. Employees' benefit are taken care by Ind AS 30, Ind AS 19, and share-based payment are covered by Ind AS 102. So, if we talk about the scope of Ind AS 32, it covers the financial instruments, but if there is a contract to buy or sell non-financial assets, it is not covered by the financial instrument, but they become financial instruments if they can be settled in net, in cash, or another financial instrument, or by exchanging the financial instruments. So non-financial instruments can be covered by Ind AS 32 only if they can be settled net. So what is the meaning of settled net? It means that the contract is not fulfilled by actually delivery of the underlying assets, but by paying or receiving only the net difference in the value. So if there is a non-financial financial item, it will be covered by India's 32 only if there is a clause of net settlement. So how it works? For example, instead of delivering goods, for example, oil, gold, etc., parties compare the contract price versus the market price and pay only the difference net amount. So in this case, it will be called as a settled net, and it will be covered by India's 32. For example, there is a contract to buy 100 units at the rate of 100, and the market price at the settlement date is 120. So if both the parties agrees that there will not be any delivery of the goods, and there will be settlement of the net amount. For example, at the settlement date the amount was 20, now was 120, price was 120, and we bought at 100, so there is a difference of 20 rupees. Multiply by the unit, so the seller will pay 2000. So if such transaction are there where net settlement is done, it will be covered by Ind AS 32. So here the key point is that only difference is settled, not the complete transaction is settled. So next is when the net settlement is assumed. First condition is if there is an explicit option given in the contract, so it means the net settlement is there. If there is a past practice that entity habitual settle the transaction in net or by offsetting or selling the contract, so it will be covered. Third is short-term trading intention. If party take delivery and sell the quickly for the profit, so it will be covered as a financial instrument. And if the commodity is as such that it is readily convertible to cash, in that case also it will be covered, although it is a non-financial nature of the item. But because it is readily convertible to cash, it will be covered under Ind AS 32. For example, in case of gold and silver contract is to buy the gold in future, and gold is highly liquid, it can be easily sold, so it will be covered by Ind AS 32. Apart from it, there is a if in case of B and C, past practice and short-term trading intention, if although trader does it and it is covered by Ind AS 32, but if it is purchasing for own use, if it is entering into an contract, although having the past practice and trading intention, but if the particular transaction is for the own use, then it will not be covered. And next is written option. If we give right to others to buy, sell non-financial item with the net settlement possibility. So always are covered under Ind AS 32, but it is not qualified for own use. So written options are always financial instruments. So decision tree, how to identify whether it is a financial contract, it will be covered by Ind AS 32 or not. So if it is a non-financial contract, yes. Whether it can be net settled, no. If it cannot be net settled and it is a non-financial contract, it will be out of purview of Ind AS 32. But if it is non-financial contract and it can be net settled, then yes, we need to check the next condition whether it is for own use. Yes, if it is for own use, then it is not under Ind AS 32 coverage. And if it is not for the own use, it will be covered by Ind AS 32. So there are three conditions. If we are dealing with a non-financial contract, if yes, then it will be we need to go for the next condition whether it can be net settled. If it can be net settled, it will be we need to check for the on use condition. And if all three conditions are satisfied, in that case it will be covered by Ind AS 32. So next is what is financial instrument? It is any contract that non-contractual give rise to financial asset of one entity. For example, cash, trade receivable, investment in bonds and deposits, or investment in equity instrument, or loan receivable, etc. Or financial assets or equity instrument of another entity. For example, loan, borrowings, trade payables, redeemable financial instrument like preference shares, etc. Or the guarantees given for the repayment of debt upon buyer's default, it will be called as a financial instrument. Here is one condition that there should be a contract. If there is a lack of contract, there is a no contract, it is not financial assets or financial liabilities. Statutory dues are not financial instruments because those are not generated from the contract. It is governed by the state law. So, for example, income tax and constructive obligation as per Ind AS 37 are not considered as a financial instrument because these are not generated by any contract. So, only the financial assets, financial liabilities, or equity instrument will be called if they are generated through a contract. Apart from it, next is equity. So equity is a contract that gives a residual interest in the assets of entity after deducting all its liability. We call an equity instrument. So simply, if we identify if it is an equity instrument, there will be residual interest. If there is a residual interest, it is equity. Otherwise, it will be a financial liability or financial asset. So financial asset is, sorry, financial liability is a contractual obligation to pay cash, financial asset, or suffer an unfavorable exchange, or settle in on share in a non-equity manner, only then it will be called a financial liability. So first is obligation to pay cash or financial asset and unfavorable actions. So for example, if we have taken the loan or there is a trade payable, it will be called as a financial liability because we have obligation to pay the amount to the lender or the trade vendors from which we have taken the services or have bought the material. So we have to pay to them. So it will be called as a financial liability because obligation to pay cash or financial asset exists. And there should be unfavorable actions. For example, there is a contract to buy shares at the rate 150 and the market price is 100. So it will be called as a liability because there is a loss of 50. So it will be called as a financial liability. Logic is that you are in a loss position, a position of financial asset. If there will be a gain, it would have been called financial asset. Next is in case of derivative that is not fixed for fix. So rule is that derivative that is not satisfying fixed cash versus fixed shares, it will be called as a financial liability. For example, option where settlement depends on the share price, it will be called as a liability. So here the logic is that when we are using our shares, it will be called, when we are using our shares as a currency, it will be called as a liability. Because, for example, options where settlement depends on the share price, it is called liability. Logic is because there is market linked obligation, not ownership link. So we call it as a trading liability. Clause B is if on equity contract, on shares are normally equity, but it becomes liability if conditions fails. For example, we have discussed that in case of non derivative, if variable shares are there, obligation to deliver variable number of own shares will be called as a financial liability. For example, pay 1000 shares. If the share price is 100, we have to pay the 1000 shares and, oh, sorry, pay 1 lakh via shares. If the share price is 100, we have to issue 1000 shares. And if the share price come down to 50, we need to issue 2000 shares. So here we are using the shares as a currency. So it is not about the ownership, but it is about the settling the liability by way of on shares. Those are used as a currency. So here logic is value is fixed, but shares are changing. So it will be called as a financial liability. So we need to check if fixed for fixed rule is satisfied, then only it will be uh, called as a equity. Otherwise, it will be called as a financial liability. So if there is a exception to this rule that if there is a right issue pro rata to shareholders and even if the currency is different, so because of the conversion forex exchange gain loss, foreign exchange rate, the amount may differ. So in that case also it will be treated as a equity. Similarly, in case of convertible bond in foreign currency, if there is a fixed number of shares and fixed exercise price, it may be in any currency, there will be a equity component in convertible bond. So where there is a change in the amount because of the forex exchange rate gain loss, etc., so it will the fixed for fixed rule will not be considered. So India, and there is some exclusions that we will discuss in next slides. That putable instruments, liquidable instruments, and future share contracts are not considered as a financial asset or financial liability. So here India says that we need to check whether the cash is fixed and shares are fixed. If both are fixed, then it is called equity. For example, pay 1 lakh rupees and get 1000 shares. Here the number of shares were changing based on the share price. So if both are fixed, it means we are not using our equity shares as a currency, so it will be called equity. If anyone is variable out of that amount of shares, any one factor is variable, then it will not be called equity. Why? Let's see, because if we pay 1 lakh and get share worth 1 lakh, so shares numbers keep on changing, so it is not equity. It is a medium to settle the liability through shares. Second case is where shares are fixed but cash is variable. For example, get 1000 shares, pay market value. So if price is 100, you pay 1 lakh. If price is 50, pay 50,000. So cash keep on changing. So it is not an equity. Why? Because your ownership is fixed, but the value you pay, it keep on changing. So it behaves like a derivative or trading contract. So if price is floating, it is not ownership. It is called trading. Next is financial asset. Any asset that is cash or equity instrument of another entity, or there is a contractual right to receive cash or financial assets or exchange financial assets on financial liability under favorable conditions, it will be called financial assets. If you remember in last slide, we have checked if there is an exchange of financial asset and financial liability under non-favorable conditions, it will be called financial liabilities. So if it is favorable conditions, then it will be called fixed financial asset. For example, entity enters into contract to buy shares of 100 after 3 months and current market price is 130. So currently there is a gain of 30. So classification will be financial asset. Logic is that you have a right to buy at a cheaper price and by exercising the options you can gain and sell the contract you can gain. So act like trading instruments or derivative. So in the money contract is always financial asset and out the money contract is financial liability. Next is interest rate swap, positive value, entity enters into swap and due to rate movement, present value become positive. So you will receive the net cash. Logic is same. If we are getting economic benefit, so it will be called as a financial asset. So any contract that is settled in on equity and that is of non-derivative nature and obliged to receive variable number of on equity shares, it will be called financial asset. And similarly, in case of the derivative, if it is settled other than by fixed amount of cash, FA, financial asset, or on equity, it will be called a financial assets. So on equity, when it is sorry, if company gives you share just to give you money, then it is not ownership, it is a financial asset. So whenever we are using our own equity as a currency, it will be called as a financial asset or financial liability. For example, on equity that is variable and not fixed for fixed, both the elements are not fixed, so it is called that on shares used as a value settlement and it will be called as a financial asset. So example first is that there is a contract, entity will receive 1 lakh worth of its own share. So in this case, if the share price is 100, then he will receive 1000. If it is 50, then it will get 2000 shares. So classification will be financial asset, not the not the equity. Logic is that focus is on 1 lakh, that value is fixed and share are just settlement medium, so equivalent to the receivable settle in the share. So it is not a ownership but it is a financial asset where the share price linked options derivative are there. So entity hold option to receive shares based on the market price and value fluctuates. In that case, it will be called as a financial asset because fixed to fixed criteria is not met. Fixed to fixed strategy is not bad. Logic is that it is a derivative instrument and it is used for trading or hedging and not ownership, but is a market link gain. So if there is a market link gain, so nature is trading, it will be called financial asset. And there are some exclusions like putable instruments, liquidation instrument, and future shares that we will discuss in next slides. So logic is whenever we are using our own equity shares to settle the transactions and using it as a mode of currency, it will not be classified as a financial asset or financial liability. So sorry, it will be classified as a financial asset or financial liability. Next is issuer must classify instrument at the initial recognition as a financial liability, asset or equity, and it is based on the contract, not on the legal form. So based on the substance, based on the contract and substance over form, it will be classified between FA, FL and equity. So in India 32, substance over form prevails at the initial for the purpose of classification, and this classification is done at the initial level. So now when the financial instrument will be called an equity, so instrument is equity only if both the conditions are satisfied. First is that there is no obligation test. Instrument must not have any obligation to deliver cash, to deliver financial asset, or to exchange something under unfavorable conditions. So no obligation, there is a possibility of equity. Second condition is that when there is a own equity settlement test, if it is set, for example, it is settled in own shares, in case of non-derivative, must not require variable number of the shares. Fixed number shares are okay. Variable number shares are not equity. And in case of derivative, there must be fixed for fixed test. For example, fixed cash and fixed number of shares, then it will be called equity. So we need to remember that fix for fix is equity. There are some special clarification that right use or pro rata use fixed amount in any currency will still called an equity, and convertible bond fixed shares plus fixed price even in forex currency, it will have the equity component. And there are some exclusions for putable instrument, liquidation instrument, and future share contract that we will discuss in next slide. So forex is allowed if fix for fix is there. So amount in Indian currency may vary because of the forex gain loss, but we'll consider it as a equity only. So let's take a few examples. A company has received INR 5 million funding from a venture capital fund for 5 years. As per the term, at the end of 5 year, company may either repay the funding with interest or settle by delivering its corporate office building. That is a non-financial asset. There is no explicit contractual obligation to pay cash. If settlement is made through delivery of the building, can the company classify this instrument as an equity under Ind AS 32? So, if we check the liability definition of financial asset, it is that a contractual obligation to pay cash or financial asset. So, in this case, if the entity does not have an unconditional right to avoid the delivering the cash or another financial asset, the instrument is classified as a financial liability. So here they have an option to settle the liability by delivering its corporate office, but they does not have unconditional right to avoid the delivery of the cash. So because of this, as the entity does not have unconditional right to avoid the cash settlement, it will be called as a financial liability. So let's take some example. Preference shares where there is a no mandatory redemption. So it means it falls in the definition of the equity that there is a no obligation to deliver cash or financial asset. So it will be classified as a equity. Next is preference shares with mandatory redemption or holder may demand. So it means entity has an obligation to deliver the cash. So if obligation exists, it will be called as a financial liability. Next is non-redeemable preference shares and dividend at discretion. So here there is no obligation to pay either to redeem the shares or dividend also. So it will be classified as an equity. And redeemable preference shares, even if subject to condition like profit, government approvals, etc. So here also it cannot redeemable preference shares. So we have to pay obligation to pay exists. So it will be called as a financial liability. Next is redeemable only if the holder exercise options. So the issuer has liability to pay. So it will be classified as a financial liability. Next is option, cash or share, but shares are very costly versus cash. So again, it is a financial liability because in reality, company will pay cash. So obligation is substance is there. So it will be classified as a financial liability. Next is deliver share equal to 100 rupees. So here again, we are using our equity as an currency mode. So it will not be classified as an equity, but it will be classified as a financial liability. Next is deliver shares equal to the value of quote. So again, we are using the currency as a medium of exchange as a currency. We are using our equity as a mode of currency. So it will be called as a financial liability. And deliver fixed shares for variable cash here also fixed for fixed test is failed. So it will be called as a financial liability. Deliver 100 shares for 100 rupees. So here fixed for fixed test is passed. So it will be called as a equity. Deliver 100 shares for no consideration. Here also fixed for fixed test is passed because value is 0 for 100 shares. So it will be called as an equity. Share options, buy fixed number of shares at fixed price. Again, test is passed, so it will be called equity. For contract to buy on shares. This we have not discussed. We'll discuss in next slides of treasury shares. So it is called as a financial liability. I will explain it in later slides. And net settled share options. So it will be financial liability because settlement is in cash. So it will be always liability. Another is ABC Limited has issued two class of shares, equity shares and preference shares. The preference shares are redeemable only at the option of issuer. So there is no obligation to settle. Okay. But it carries the fixed cumulative dividend at the rate of 12% per annum. And dividend payout can be deferred indefinitely at the discretion of director. So both the things are can be deferred at the discretion of issuers, redeemable also and dividend also. No dividend can be paid on the equity shares until dividend or preference shares is paid. It doesn't matter. ABC expect to pay regular dividend on both the classes of the shares. It is a practice, but we have to classify as the terms of the contract. How should the preference share be classified under Ind AS 32? So preference share should be classified as equity instrument because there is no contractual obligation on the entity to deliver the cash or another financial asset. Further, the expectation of paying regular dividend does not affect the classifications as the classification, as I have told you, is based on the contractual term, not on the management intention or expectations. Since the preference shares are redeemable only at the option of issuer and dividend payment is also discretionary, so it does not create a financial liability. Because as per the definition, financial liability is a contractual obligation to pay cash or financial asset. So in this case, it is on the discretion of the issuer. There is no contractual obligation, so it will be classified as equity instrument. So next we will So if any of the condition fail, then it is not an equity. It will be classified as financial liability or financial asset. So if there is an obligation to pay, it will be called equity. Oh, sorry, it will not be called an equity. It will be classified as liability. If there is a variable shares, it will not be classified as equity. It will be classified as liability. And if fixed for fixed test is passed, it will be classified as equity, not an liability. So there are some exceptions. First is putable instrument, that is one where the holder has right to return or put back the instrument to user and receive cash or financial instrument. So normally putable instrument are considered as a liability, but it can be treated as equity also if it has all the conditions. For example, it shares the net asset on the liquidation, and it is most subordinate class of instrument, and it has identical features. There is no other obligation, and return is linked to the performance. If these conditions are satisfied, then putable instrument may be classified as an equity. Further, we need there is one another condition that no other instrument should fix or restrict the return of putable instrument. So why this condition are required? Because the equity means residual interest. That is the last claim. If someone else take away that residual return, then putable holders are not true owners. So it will be classified as equity. It cannot be classified as equity if someone else is taking their return. For example, equity classification allowed. For example, in mutual fund units, investor gets share in NAV. No other instrument exists. So condition of A and B both are satisfied. So it will be classified as an equity. But situation is that putable instrument units exist, but company issues another instrument, and that is instrument X, and it gets 80% of the profit, and putable holders get only 20%. So their return is restricted and fixed. So 16B is violated. So it will not be considered as a equity instrument, but it will be classified as a financial liability. So memory hook is if someone else control profit, then you are not equity holders. Further, a entity shall not consider non-financial contract with the holders having similar terms as third-party contract. For example, normal business transactions with the holders we need to ignore. For example, investor also supply goods to company and contract term same as the vendor. This is a non-financial contract and we will not consider it while checking 16B. Why? Because it is not designed to manipulate the residual return. It is a normal business transaction. So here we need to ignore the normal business dealings. So here, if the condition of 16A is satisfied, that the putable instrument share in the net assets on the liquidation, and there is a more subordinate class identical in feature, no other obligation, and there is a return linked to the performance, then we need to check whether is anyone else is taking the benefit or fixing or restricting the returns. If no, then it is equity. But if yes, someone else is fixing the return or restricting the return, then it will be classified as a liability. And if we cannot assess the 16B condition regarding the restrictions, then it will be called as a liability only. Next is if there is an instrument has an obligation to deliver pro rata share of net asset only on liquidation. Normally it is called financial liability, but in exceptions it can be equity also. When does the obligation arise? A liquidation may be certain, for example, limited life entity, or uncertain but controlled by the holder. So here only liquidation payment is there, then it may be possibly equity. So we need to check certain conditions that it holder must receive pro rata shares of net asset. Asset means assets minus the liability, and pro rata calculation is dividend divide the net asset in the equal units, multiply by the units held. So in this case, first condition that it should receive pro rata shares. Next is it should be most subordinate class instrument, the last in the priority. It must satisfy that no priority over other claim is there, no need to convert into another instrument. Third is identical in feature, that all instrument in that class must have same obligation, same pro rata sharing rule and same contractual obligation. In that case, it will be classified as a equity. So here we need to check, even though the obligation exists, still equity because we are getting the return that is residual. There is no fixed payout and it is paid only after the liability. So it is classified as an equity. Similarly, in case of the LLP or partnership, it receives the share in net asset on the liquidation. So it is classified as equity. So basic distinction is that payment timings, it is only on the liquidation. So equity. And in case of liability, if it is fixed and ongoing. So in case of the equity, it is residual, but in liability, it is fixed. And in case of the equity, nature is of ownership like, and in liability, it is of obligation. Next is, even if we satisfied this rule, but still we need to check there that no other instrument should disturb the return. So although the 16C para gives the structure that it is residual and we will get the return pro rata, subordinate all class and identical in feature, still we need to check whether someone else is restricting the return. So we need to check instrument is equity only if no other instrument contract that competing the cash flow. No other instrument should have cash flow based on the profit and loss, net asset, and fair value of the asset, meaning no one else share or track the residual performance. And restriction text that no instrument should restrict the return, fix the return, limit upside of the holders, meaning putable liquidation holders must have unrestricted residual interest. Only then it will be covered as an equity. So if instrument A gets the residual return, instrument B get 80% of the profit. So in this case, instrument A gets only 20%, so residual interest is restricted, and result it will be called as a financial liability. Similarly, only one class exists, all shares are equal, there is a no restrictions, it will be called as an equity. So we need to ignore the non-financial contract if they are of normal business transactions and similar to third party contracts. For example, holder is also a supplier, contract terms are normal, then we need to ignore the 16D rule. So ignore normal business dealings, and critical rule is if entity cannot confirm 16D conditions, so it will be considered as a liability. Next is settlement in own shares. So own shares are not always equity. So classification depends how the settlement is structured. For example, if there is variable share settlement, it is liability. We have already discussed it. For example, the share equal to 100, share equal rights to value of goods, value of gold. So share are used as a settlement tool for the value, not for the ownership. So where there is a variable shares with the value settlement, it is called liability. Next is fixed for fixed test. It is the equity rule. If there is a fixed cash and fixed shares, it will called as an equity instrument. For example, we buy 100 shares of 10,000. So it is a equity because fair value change is ignored here, and premium received will be settled in equity, and premium paid will be deducted from the equity. So if there is a fix for fix, then we consider it as a equity. So there is one exception if even if there is a fix for fix, but if shares are putable instrument or liquidation instrument, so these financial instruments are not considered equity because these instruments are not true ownership instrument because holder is entitled for pro rata share of net assets often on liquidation. So economically they behave like a residual claim but with the obligation feature. Hence, standard avoids showing them as an pure equity, but we need to check for putable and liquidation instrument the conditions that we have discussed earlier. If they are in nature of residual interest only, then we can classify them equity. So, fake equity is not equity. Buyback obligation is a liability. If entity must buy back its own share, then it will be called financial liability. Forward contract to repurchase shares, written put options, and it will be measured at the present value of redemption amount. So when we are entering into contract to buy back its own share, so it will be called a liability. Fixed shares plus variable cash. So fixed shares but variable cash, it will be called financial assets or liability. Deliver 100 shares, receive value of gold, so it's a cash fluctuates, so it will not be equity. So if there is a variable shares, it will be called liability because value it is value based. If fixed for fixed, then it will be called equity because ownership is there. Fake equity, financial instrument, not real equity, financial liability. And buyback obligation will be called liability because payment obligation is there. If there is a variable cash, then we'll call it a financial instrument because value is uncertain. So if variable shares, liability, fixed for fixed, equity, buyback, liability, floating value is not equity. So let's discuss about the reclassification. So the rule is that reclassification happen when the condition of 16A to 16D are changed. 16A talks about the features that it is putable. There is no 16B, there is no restriction. 16C liquidation residual and 16D there is a no competition about the return on the instrument. So any of the condition because of which we have classified the instrument whether financial asset or equity or liability if has changed then we need to go for the reclassification. So start being satisfied we need to move equity but when it stop being satisfied as an equity we need to move to the financial liability. So when to reclassification is to be done from the date of conditions are changed. And for example, non-putable instrument redeemed, residual become pure. From the date this happens, it will be classified as an equity. So accounting follows the substance as the date. So residual becomes pure means that no other class of instrument competes for the profit or restrict the return. So financial liability that we decided we need to change to the equity. So memory hook is that if condition are changed, we need to change the classification. So why classification? Because classification depends on the current rights and obligations. So if the rights and obligation have changed, we need to change the accounting also to reflect the economic reality. For example, when instrument fails condition of section A to D, for example, initially there was only one class, we classified it as an equity, but later on new instrument issue taking 70% of the profit, so residual become restricted. So we need to reclassify the instrument that we reclassify initially at equity to the financial liability. So liability will be measured at fair value and difference we need to adjust in equity. This we will discuss when we will discuss in DS 109. So next is financial liability. when the instrument meets the condition of section A to section D. For example, initially another instrument exists. We classified it as a liability. Later on, that instrument is removed, so residual become pure. So we need to classify it as an equity. So accounting treatment will be, we need to measure the liability at current value of the equity. In the case of equity, we measured at fair value, but in this case we need to measure at carrying value of the liability. There will not be any loss or gain. So key difference in the treatment is, when we are reclassifying from equity to liability, we need to do it at fair value, and difference we need to adjust in equity. But when we are reclassifying from liability to equity, we need to we need to measure it as carrying value, and there will not be any gain or loss. So conceptual logic is that from reclassification from equity to liability, there is new obligation arises, so that need to measure at fair value. But in case of the liability to equity, obligation is removed, just convert existing carrying amount. There will not be any loss or gain. So financial liability, obligation to pay cash or financial asset under unfavorable exchange, but in case of the equity, there is no obligation to pay. So obligation is liability, no obligation is equity. So there is an important clarification about the dividends. Even if equity holder receive dividend, still it is not a liability, because company is not obliged to pay dividend. So dividend is at discretion, is not an obligation. Next is substance over form. Classification is based on the substance, not on the legal form. For example, preference shares with mandatory redemptions, it may look like equity, but actually we have obligation to pay, so we will classify it as a financial liability. So if there is a putable instrument, so holder can demand cash, so it is a financial liability, unless there is an exceptions of 16A to 16D. So look like share may not be equity. So putable instrument examples are mutual fund units. Investor can redeem anytime. This is a liability. So holder exit right exists. It is a liability. Unconditional rights. If entity cannot avoid payment, it is a equity. For example, payment depends on holder's option. Still liability. Restrictions. For example, RBI approval is not there. We are not eligible for the forex. This does not remove the liability. So no escape is liability. Indirect obligation rule, even if the obligation not explicit but it can exist in substance, then also it will be called as a liability. For example, must pay cash if dividend was not declared, it is a liability. Settlement cash or shares, but share value is greater than cash. In reality, company will pay cash because share value is too high. We will discuss this with one example. So we will call it as a liability. So substance create an obligation. Big concept is that India focuses on economic reality. Explicit obligation or indirect obligation is liability, but no obligation is equity. So obligation to pay is liability. No obligation is equity. Holder can force payment. It is a liability. Only discretionary payment. So there is no obligation. It will be classified as an equity. And if it is indirect obligation, then also it will be called as liability. So ABC Limited issued two classes of shares. I think we have discussed it. Reclassification, this we have discussed. Equity, this we have discussed. Sorry. and contingent settlement. So, if a financial instrument may require payment of cash or financial asset based on uncertain future events, so it will be called as financial liability because we hold the obligation to pay. So, if uncertainty can force payment, it is a liability. What are the contingent events? So, it may be events beyond the control of the both parties. For example, if stock exchange change, interest rate, tax laws, etc., etc. But if payment is conditional and entity cannot avoid the payment, it will be called as a financial liability. For example, if profit exceeds 50 lakhs, company must pay 10 lakhs. So, it is a liability. So event uncertain but obligation exists, it will be called as a financial liability. Why? Because entity does not have unconditional right to avoid the payment. So if condition happens, we have to pay. So it will be called as a liability. So there are some exceptions where the instrument is not liability if any of these apply, that if these payment conditions are not genuine. For example, pay if India GDP becomes 1000 trillions overnight. So we need to ignore because this is not real. If settlement is only on the liquidation, so it can be equity in that case because there is no obligation to pay. So there is a possibility of equity. We need to check other conditions for para 16A to 16D. And if 16A putable exception is there, if it met all the conditions, that equity is possible. So if contingent payment exists, we will call it liability. If there is no genuine condition, we need to ignore it. If it is only on the liquidation, it may be equity if it meets the other condition. So India's particularly checks whether can entity avoid payment. If yes, then it is equity. If no, then it is not. It is if cannot avoid payment, then it is a liability. So settlement options. If a derivative contract has settlement choice, whether in cash or in shares, it is a financial asset or liability unless options results in equity. So if any option is a liability, whole contract is a liability. So because one party can choose cash settlement, another does not have unconditional right to entity does not have unconditional right to avoid the payment. So choice to pay is risk of liability. For example, share options, issuer can choose to pay cash or issue shares. So cash option exists. So it will be called as a financial liability because we cannot avoid to pay cash. So if cash option is there, we have to, it kills the equity option. In case of the non-financial contract to buy goods and settle by delivering goods or net cash. So here also cash settlement is possible. So the instrument will be classified either as a financial assets or financial liability. So net settlement is always a financial instrument, although it is non-financial contract. And exception only if the all settlement options are equity, then it will be equity. For example, fixed shares, fixed cash, there is no cash alternative, then it will be classified as an equity. So if we summarize, if we choice include cash, then it will be a financial liability. If there is a net settlement is possible, then it will be a financial instrument, whether financial asset or liability, it depends. And if all options leads to equity, then only it will be classified as an equity. So big concept that equity can entity avoid cash settlement. If yes, then it will be classified as equity. If it cannot avoid the cash settlement, then it will be classified as liability. Next is compound financial instrument. So some instrument may contain the liability component also and equity component also. So these are classified as financial instrument, compound financial instrument. And in this case, as it is having two component, liability of and of equity, so we need to split these instrument in financial liability or equity based on the substance of the contract. So, for example, convertible bond. So it has the debt option also. We need to pay interest and principal, and options is there to convert into share. So the debt part is a liability and conversion option is equity. So convertible bond has two options, two parameters, debt and equity. So why we need to split it? Because there are two different obligations exist. To pay the cash, it is liability, and give the ownership option, it is equity. So this value is equivalent to debt plus warrants. So here, once classified, we do not change the classification later, even if the conversion become highly likely. Still, there is no classification. So once classification is locked, there is no change. So total value of the compound financial instrument will be equal to the liability plus equity, and these are the steps. First, we need to find the fair value of the old instrument, then find the liability component value, and balance will be the equity component. This we will discuss in when we will discuss 109. So there is no gain or loss on the initial split, and embedded derivatives non-equity will be classified as liability, and equity will be the residual interest. So first we value the liability as a similar debt without conversion, and the remaining amount will be called as an equity. For example, the issue price is 1 lakh, the liability value is 90,000, so equity will be 10,000. So debt part is liability and measured separately. Conversion option is equity, it will be a residual value. So India's separates the payment obligation with the ownership obligation into liability and equity. So in case of convertible instrument, we need to split it, and residual will be classified as equity. Next is treasury shares. So here core principle is that when a company buybacks its own share, these are called treasury shares. So treasury shares are deducted from the equity, and they do not have any PL impact. So own shares are equal to own capital. There is no profit and loss. Why no? Because there is not a transaction with the outsider. It is adjustment in equity only. So transaction covers no gain loss in PL for sale, issue and cancellation. All adjustment are directly in equity. For example, company buybacks shares for 1 lakh. So we need to reduce the equity and sell the treasury shares at 1 lakh 20,000. Extra 20,000 goes to equity, not into the P&L. So there is one exception. If treasury shares are held in investment fund or insurance contract participating, then entity has a choice not to deduct from the equity. Either it can instead it can treat it as a financial asset and measure at FVTPL. So this election is irrevocable and instrument wise, and this we will discuss in detail when we will discuss 109. So a special fund can treat all shares like investment. So for 33A, insurance company holds own shares in fund instead of reducing equity, so they can treat it as a financial asset, and we need to disclose it in balance sheet and notes separately. And if these are bought from the related party, so we need to disclose under Index 24 also. So buyback we need to deduct from equity, sale or ratio we need to adjust with the equity, and there will not be PL impact because there is no profit from yourself. You are not dealing with outsiders, but you are dealing with your own self. And in case of there is exceptions, treasury shares are held in investment or in insurance contract, that these can be classified as a financial assets under FVTPL method, and we need to provide the disclosures. Next is treatment of interest, dividend, losses and gains. So financial liabilities we will treat in P&L, and equity will be treated through the equity. So financial liability treatment recognized in P&L for interest, dividend and gain loss. And the example preferential classified as a liability, we need to book expense in profit and loss. So liability behave like a debt. For equity instrument treatment, we need to recognize in equity for dividend, share buyback impact, and issue premium. For example, equity share dividend, we need to adjust in equity, not in P&L. So equity is owner's transaction. So key logic is that liability is cost of financing. We need to book it in P&L, and equity is distribution to the owner. So we need to treat with the equity. So if value change, we need of liability, we need to change in P&L, and equity, for the equity there is a no measurement. So transaction cost, we need to deduct from the equity, for example, legal fees, restriction charges, stamp duty. If transaction fails, expense and P&L. And compound instruments, so we need to divide the transaction cost in two parts, for the liability component and for the equity component based on the proportion. Similarly, for the tax also, tax on dividend and equity transactions to be booked as per Ind AS 12. Further, redemption and refinancing, liability gain loss to be booked in P&L, and equity we need to adjust in the equity. Closing liability hits PL, equity stays in equity. So there are some disclosures regarding the transaction cost separately, interest and dividend, tax effect, and it may present dividend expense with interest or liability reverse. If there is a remeasurement gain, change in the liability value recognized in P&L, gain or loss, whatever it is, even if instrument has equity-like features. So interest will be booked in P&L, dividend will be booked in P&L, and for equity will be booked in equity. Gain loss for liability in P&L, for equity in equity. Transaction cost for liability in P&L, for equity and equity. Fair value change for liability in P&L, and for equity it is not remeasured. Equity is not measured, so there will not be any liability. Next is offsetting of financial assets and financial liability. So when you can offset, only if both conditions are satisfied, there is a legally enforceable right to set off and intention. So there are two things. First is the legal right and second is intention to offset. So meaning of offset is to show net amount in the balance sheet. Instead of showing assets and liabilities separately, for example, asset 100, liability 100, we need to offset it in balance. We will show as an asset of 20. So why it is required? Because net presentation reflects the actual expected cash flow. If only net amount will be settled, then show net. Why to show separately assets and liability? It will increase the value of assets also and liabilities also. So we need to show it as a net, not gross. So offsetting and derecognition both are different thing. For example, offsetting is net presentation, derecognition is to remove the item. So there will not be gain loss in offsetting, but in derecognition it is possible. So right offset of, there is a there should be legal right to adjust the receivable against the payable. For example, you pay 100, you owe 100 and other party owes 80, so we need to set off and pay 20. So here, first we discussed that for offsetting there are two things, that it should be legally enforceable and intention to settle should be there simultaneously. So here there should be intention also. If right exists but there is no intention, so they cannot be offset. So right without intention is no offset. Simultaneous settlement offset allowed if settlement happens at the same time. For example, clearinghouse settlement, no risk exposure, and offset is allowed. When offset is not allowed, if there are synthetic instruments and same risk but different counterparties, there is a collateral arrangement, sinking fund, insurance recoveries are there, so it cannot be different contract, we cannot offset. So master netting agreement to net in a case of default but not enough for offset must still satisfy para 42 conditions. Like that, there should be legal enforceability and intention to settle in cash, then only we can offset. So key concept is that NDS check whether there is a legal right or intention. If both are there, then yes, we can offset. Otherwise, we cannot offset. So example, offset allowed, legal agreement exists, condition company intends net settlement, then show it net. Offset is not allowed where legal right exists but settlement separately. So we need to show it gross. So right plus intention, offset is allowed. No intention is no offset. Offset is not derecognition. So this is all about India's 32. I have tried to explain you in detail, but still, if as you know, this standard is very vast. So if something is left or you have any doubt, so you may discuss on the given WhatsApp number. Thank you very much for watching it. Namaste.